right, so Joe, we're going to try something a little different. We've done the kind of stare at the camera and, you go, I go kind of thing. I think we're going to try to make this a little informal podcast style. Is that okay with you?
Works for me.
Can you handle that?
Ready to go.
Excellent. I should hope so. So welcome everyone. Here we are again. We've been wanting to put this video out, and a day becomes a week becomes a month. It's crazy how fast time goes. Although if you're living in New Jersey, the weather doesn't change much, as not too nice outside. So how you been, Joe? Everything all right?
Everything good. Everything good. Can't complain.
Excellent.
Yourself?
I'm doing good, Joe. I'm doing good. We got a lot to get to. Tons of questions out there.
Let's dive right in.
Let's get to work, right? Let's get to work. So, first thing I want to do, look back at Q1. Like I said, I can't believe that we're already past it, but market returns, right? I know there's seemingly been some headwinds that you would maybe think would cause some adversity in the market, maybe some volatility, but onwards we march, right? Mm-hmm. S&P, I think today, as of we're filming this April 1st, up a little over 10% on the year. Mm-hmm. The Dow up a little over 5%, bonds not so much. But how did we get here, man? Where are these returns coming from? What's
interesting, right? I mean, you would think we started the year out, we were going to have 7 rate cuts. It's going to be this great year for the equity market, right? You have the first 2 inflation prints kind of come out, both CPI and PCE, come a little higher than expected. So those 7 rate hikes kind of unwind. And as you know, with rate hikes, lower rates, better for equity markets, usually better for fixed income markets, easier access to capital for corporations. Those rate cuts are unwound, basically meaning higher rates for longer rather.
So the market should have
not moved up 10% most likely, but expect the unexpected, right? I mean, I think the market just continues to be forward looking, continues to try and push Powell to kind of do these rate cuts. And, it's been interesting to kind of watch really how much it's unwound and really how resilient the market has been, right? As the quarter's gone on, we've seen a lot of those traditional recession indicators kind of go from most of them being flashing red. We've actually moved to a little bit of a flashing yellow, right? Okay. So not back up to that green light just yet, but the one thing is we've been saying over the last year or so, hey, listen, the numbers are still not strong. The numbers are still not strong. They're still not strong, but the pendulum has swung back from, decidedly, hey, recession's somewhere on the horizon, to the numbers kind of telling you, kind of a wait and see approach a little bit. So we've almost come full circle a little bit, but it has been an interesting first quarter for sure. You mentioned fixed income down a little bit, right? I think, you have those rate cuts, the ability to go to any, more places to find yield. Those bond prices kind of getting depressed a little bit here in the first quarter. Not necessarily a knock on the economy as a whole or the fixed income market as a whole, just kind of that rate trade being unwound a little bit. So you have those slightly negative for the first quarter. But yeah, largely, you have the Dow up 6 or so, the S&P up just about 10, the NASDAQ just right around there as well. So it's been an interesting start to the year for sure.
To say the least. Now, I'll throw, you and I are sports guys. We like the NCAA tournament, so I'll throw out some other acronyms out there. How about CPI? How about PCE? Now, I know those two terms, I don't know, the average person may or may not understand, right? But the data that brings out, what CPI is, pretty much a standard basket of prices, whereas PCE, I believe, is a little more dynamic, right? Takes into account prices, right? So if the price of beef goes up, people buy more chicken, that kind of thing, and so it's a little more dynamic. Do you have one that you look at more, or how do you use those two pieces of data?
Yeah, I guess if I was Jerome
and how do they affect Q1? Sorry.
PCE is the Fed's preferred inflation gauge, kind of a little bit less volatile of a number. So they kind of use that as their main one. That was what came out. Everyone was enjoying their day off. If you work with the market last Friday on Good Friday, that PCE did come out. It was, a little bit, it had cooled a little bit versus some prior months. Pretty much in line with expected, and expected at this point is that it's coming down. So that's kind of investors have kind of held on to that a little bit since last Friday and said, okay, we have a meeting in May, Fed meeting in May. We're not going to cut there, but they're really holding on to that June meeting as like, all right, this is where cuts are going to begin. And if you listen to Powell, he said, it's kind of going where expected, no cuts, needed just yet. And then you look at the market and what's pricing in there saying, hey, we're holding on to June. That price is, the probability of them doing a cut, the Fed, that is them, was, just north of 50. Now you look at it today, just north of 60. So the market's really trying to force that on in terms of when the rate cuts are going to kind of happen. Remains to be seen. I think, we had 2 hotter than expected inflation prints to start the year. That kind of unwound all those rate cuts that we were just kind of talking about. Then you had one cool one. Everyone's like, all right, rate cuts are back on, right? So we'll see. There's a lot of time between now and June 12th, which is that meeting. Again, we have another Fed meeting May 1st as well, so a lot remains to be seen. But Yeah, PCE is certainly the Fed's preferred inflation gauge, but CPI is always going to be CPI. That's always going to be kind of the bread and butter that everyone, kind of takes a look at. So.
Okay. So like we typically like to do, look back, all right, Q1, let's look ahead now, Q2. What's on your radar as we enter into April and in the second quarter here?
Yeah, I think first thing that's going to come about earnings season, right? So second week in April really kicks off earnings season. Delta Airlines is going to kick us off. So no shortage of headlines in the airline industry currently, right?
Indeed.
With all things going on in Boeing and some of the safety concerns across the industry. So, that's really, the balance of April is going to be filled with earnings news, right? I mean, obviously we're going to get our economic data out here, but I think it's going to be important to see, hey, who's still continuing to talk about inflation? What sort of sector-specific issues do we have out there, right? We had the Baltimore shipping disaster there last week, right? There's going to be some commentary about supply chain. Who's that affecting? Who's that not? I'm sure, a lot of that's played into the market already, but it's always interesting to get this commentary from the CEOs and the CFOs of, all the largest companies.
Is it about one company's commentary moving the needle, or is it about all of it kind of put together, kind of giving us a direction?
Yeah, I think there's always one or two things you can learn throughout the earnings season of, maybe didn't realize this or maybe didn't realize that, right? I think it's going to be the overall tenor of, both obviously on sector-specific things, how are certain things going to play out across the sector, but then you kind of overall, right, you look at inflation, you look at rates, it's going to be the overall tenor of what people are saying. I think, we saw a peak in terms of how many of the companies were talking about inflation in their filings, kind of come down a little bit over the course of the last couple of months, thinking that inflation was going to kind of come down, and maybe that's no longer an issue for certain companies. But it's, the overall tenor. We'll see, kind of what that feeling is, how it kind of leads through, all the companies kind of in the S&P 500 or so, and really kind of take stock of it from there.
Sure.
But that's going to set the tone really for April. And then you can kind of get an idea, because, listen, we have the economists on TV, we have the Fed. It's good to learn really, hey, people running, the biggest and strongest and most productive companies in the country and really around the world, what are they feeling? Because they're the ones, from top to bottom, from having to buy goods to turn them into something else, to employee type issues, to shipping. They kind of, a lot of these companies are such conglomerates nowadays. You really get a good read on the economy. You throw an individual company like an Amazon or what have you. So it'll be interesting to see some of their commentary, what they're feeling in terms of their price pressures and rates and cash needs and things like that. So, it's always good to get some feedback from, from all those kind of professionals in those, big time seats.
Right. Now, you talked about the Fed meeting coming up in, is there one in June?
We have one in May,
one in June.
Right? Yep.
What are we thinking? What are we looking for there in terms of timing with some other data that might be coming out? What are our thoughts there?
Yeah, so next Fed meeting, May 1st, right, is going to be the period in which they kind of meet down there in D.C. Then we have another one on June 12th, right? So we'll have one more set of inflation numbers between now, last meeting, and, the May 1st meeting. And then because we have the balance of May and early June, we kind of have, two sets of some of the prints, right? We should get two CPI type numbers and some more PCE numbers in there. And the Fed's in a blackout period, which basically means that they're not allowed to take into account any of the information that comes out in that period in their rate decision, right? So that blackout period is going to extend across some of the inflation data there in early June. So I think if we see any hiccups here in April or May where it's like, maybe not quite yet, maybe they just punt that ball down the field a little bit and say, hey, we have another meeting in July. We'll have another additional sets of numbers here to really confirm what we want. I mean, again, if you look at what Powell's really been saying, he's really been dictating the market, trying to as best as he can. He's going to wait until he's sure that, we're not going to go back the other way in terms of inflation. But, at this point, I think they may kick it, from June. Right now it's priced in for June, but we'll remain to be seen from there. Yeah.
Interesting. Now let's talk about some actionable stuff, some things that we're giving some thought to here. And one of them has been a lot of our interactions with clients is a discussion on cash. Where the best place is if you have some cash on the sidelines, if you're holding on to some cash in a savings account, maybe your checking account's getting up a little high. What are some ideas, some thoughts in terms of, hey, where rates are, where they might be going, and where's the best place for that cash?
Yeah, I think everyone's been spammed right over the course of the last probably 18 months with savings rates and high yield savings rates and move your money here and get this promotional rate, right? So those are all great. And with rates having moved up so rapidly, those numbers were just going higher and higher and higher, right? If we're thinking we're near the end of the rate cycle, right, where the next move is either flat or down from here, right, which I think is probably the overwhelming probability at this point, those rates are going to be the first ones to get cut, right? So, what we can do is we could say, okay, hey, that savings rate's good. It's paid us well for the last 12, 18 months, what have you. Maybe take a step out and say, hey, listen, how can we lock in this CD for an additional 12 months or 18 months or 24 months, what have you, or look to some sort of fixed income instrument that says, okay, hey, listen, I'm going to buy this today at a 5% coupon. I'm going to continue to get that income flow, from between now and to the point of maturity, right? The thing that's going to happen with a lot of these savings accounts is that's going to be the first thing that gets cut. The Fed cut rates, that rate's going to come down in lockstep, whether there's going to be no grace period, there's going to be no, hey, we'll give you an extra week or whatever. It's going to be pretty quickly. Just as fast as they went up, they're going to come even faster on the way down in lockstep with the Fed kind of
and for retirees, it's a real opportunity to lock in that yield, and it's valuable for sure. It's been a while. I mean, you've been in the business for a while. When's the last time you've seen the ability to utilize short-term treasuries, things of that nature to get the type of yields?
Yeah, I mean, the Fed started to hike rates a little bit before COVID, but we didn't really get anywhere meaningful. I mean, you have to go back before the great financial crisis, so you're talking mid-2000s and then really into the 90s where you could see some real substantive rates kind of on money markets and savings accounts and things like that. So I think to your point, for retirees and everything, hey, listen, it's great that you've been getting this number for a while. Let's figure out how we can lock in something close to that for some period of time in the future to say, okay, hey, 6 months from now they start cutting rates, and even if you only get another 12 or 18 months of that higher rate, for a little bit longer,
definitely,
it could be a meaningful difference in somebody's plan, right? We're always trying to eke out as much income and performance as we can in terms of everybody's plan with obviously their risk in mind.
Correct.
So we want to be making sure, hey, listen, I'm happy you've had the money in the savings account. Let's just have a conversation around, hey, is there somewhere you're comfortable moving it that's, still very safe, but maybe, gives you a little bit of advantageous position here, irregardless of what the Fed decides to do with rates.
Absolutely. And you touched on the planning side of it, which comes into play there, obviously. Something we're proud of that we do for our clients in building a plan, and how does that cash allocation fit into that plan. On that note, planning and all that stuff, we got some new technology coming out. I know you guys have been working on that. We've all been hard at work building that. Give me 30 seconds or so, talk about what we can look forward to in terms of the new technology.
Yeah, sure. So for all of our Paradigm clients, we've been working hard at rolling out a new web-based interface and app, right, in order to access your clients. So you'll see, we're going to be having some launch events coming up soon. You'll be able to go into your App Store or your Google Play Store, what have you, find the Paradigm app, download that. We'll get you a username and password. You'll be able to see all your accounts, both at Paradigm and elsewhere. If you decide to link all those together, there'll be a secure vault for us to kind of send information back and forth if we so please. Push these videos out to you where they kind of pop right into you in the app or via your email. We think it's really going to take our client service experience really to the next level. It's something we've been working hard on for quite a few months now, in the final stages of build out, pretty much ready for launch. So look out for that. We've subscribed to some new planning softwares. We may be doing some Right Capital plans with some people in addition to some real number type plans. We have some new risk software for those people who have done a Riskalyze questionnaire, help really kind of dial in that risk that we've been talking with clients. If we do kind of hit a little bit of a bumpy patch, we want to make sure that risk is dialed in. So we're investing across the business on the tech side of it to really help improve our software and our overall client experience, right? I mean, without our clients, we don't have anything.
That's right.
So it's up to us to really make sure that the experience for our clients here at Paradigm is on the cutting edge of all client experiences in terms of wealth management. I really think the investments we've made in the last half of last year and are continuing making at this point are really going to take us to the next level.
Yeah, couldn't agree more. Well said. And finally, got some fun things coming up that relate to that too as well. Some events for our clients. One, tax season's coming up, right? So we want to help out. You might have some extra papers laying around you want to get rid of. We're going to be doing a shredded event here at the office. We'll have more details on that going to our clients. We've got that coming up. We're doing a lunch and learn event, having a elder care attorney come on in to discuss some of the things that you may be aware of, some laws and some things you may not be aware of, but certainly about. These are the types of things that we like doing for our clients, right? We want to be doing these types of events. So we got that coming up. And during those events, we'll have conversations about, hey, let's take a look at the app. Let's get that going. Let's take a look at some of that stuff. So, yeah, man, we got a lot of exciting stuff coming up. It ain't just about NCAA March Madness. We got our own little stuff coming up. So, Joe, as always, thank you for joining us today. Thank you, everybody, for tuning in. We'll be coming out with these at a better frequency as we get more accustomed to the schedule. So thank you for joining us. Stay tuned. We'll be back again.